This is ShadowQuant, Stocks, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 29, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 is sitting in a precarious standoff. While the broader index holds its ground, the market is fracturing along sector lines. The technology sector is under fire, dragging down the Nasdaq, while capital is fleeing into healthcare and consumer staples. It's a textbook defensive rotation, but the breadth data tells a more complex story. Is this a healthy rebalancing, or a warning sign of deeper structural weakness ahead of the Fed's decision on July 29th? We're going to dissect the flows, the charts, and the risks. Let's look at the calendar. The most significant event on the deck is the Federal Reserve's rate decision, coming tomorrow, July 29th. The market is pricing in a hold, but the post-meeting commentary will be the focus. On July 30th, we have a heavy data docket. The second estimate for second quarter GDP, initial jobless claims, and the Personal Consumption Expenditures Price Index. This PCE print is critical as it's the Fed's preferred inflation gauge. Additionally, we have the Case-Shiller home prices data releasing today, July 29th, which will give us a read on the housing sector's resilience. And finally, we have earnings from ADP, EAP, and Aerolite today, though the bigger market movers are the pre-market gaps we're about to discuss.
The key here isn't just the rate decision, but the dot plot and the economic projections. If the Fed signals a pause but raises inflation forecasts, that changes the risk profile for growth stocks immediately.
Spot on, the narrative is shifting from when will they cut to what is the inflation trajectory. Let's get into the market data. Here is where we stand in the after hours. The S&P 500, tracked by SPY, is up 0.2% to $740.86. The Dow Diamonds is stronger, up 1.1% to $526. But the Nasdaq 100, QQQ, is down nearly 1% to $675. The Russell 2000, IWM, is flat, up a fraction to $293. Let's talk about the headlines moving the needle. First, we have SOFI Group, SOFI. The stock is gapping down 6% pre-market, despite the CEO calling 2026 a defining year and raising guidance. Retail investors are shrugging off the positive news. Second, OI Glass, open interest, is crashing nearly 15% after an earnings miss. Third, we have Lennox International, LEI, down nearly 10% on flat earnings per share. The crowd is exhausted. The Fear and Greed Index is sitting at 39, which is deep in the fear territory. When you see a stock like SOFI raise guidance and still sell off 6%, it's not just about the stock, it's about the absence of buyers. The put-call ratio for SPY is at 8.76, which is extremely high. Traders are buying protection, not chasing upside. This is a sell the news environment where any headline that isn't a miracle gets punished. The sentiment isn't just cautious, it's defensive. Investors are moving cash from speculative fintech into boring, yield-producing sectors like healthcare and staples. So the market is refusing to buy the narrative. Let's look at the charts. Grid, how does QQQ look technically as we approach the Fed decision?
The chart on the Nasdaq 100 is ugly. QQQ closed at $675, down nearly 1%. We are testing the lower boundary of the recent consolidation range. The 10-day range for QQQ is 667 to 724. We are currently trading in the bottom 10% of that range. The 50-day moving average has been broken. More importantly, the relative strength of QQQ against SPY has deteriorated significantly. While SPY held support at $735 yesterday, QQQ failed to hold its own momentum. We are seeing lower highs on the daily chart. If we close below 667, which was yesterday's low, we open up a path to the June lows.
I want to add context to that breakdown. The institutional flow data confirms what the chart shows. We are seeing net outflows from the QQQ heavy tech funds over the last 3 sessions. Meanwhile, inflows into the healthcare sector and consumer staples are accelerating. This isn't retail selling, This is institutional portfolio rebalancing. The CFTC data shows commercials are at the 100th percentile in bullish positions across many commodities. But in equities, we are seeing a shift. The smart money is reducing duration exposure. They are selling growth to buy value. The SOFI miss is just one data point in a broader trend of earnings being met with skepticism. Even when companies beat, if the guidance isn't explosive, the market sells.
I'd add a risk warning here. Everyone is focused on the Fed, but look at the volatility surface. Yesterday, the VIX closed at 18.67. That's not a crash, but it's elevated given the VIX rank. More importantly, the put/call ratio for QQQ is 9.24. That is extreme. When put demand is that high, it often signals a capitulation point, but it also means any positive surprise from the Fed could trigger a violent short squeeze. However, the broader risk is credit. If the yield curve, which is currently flat at plus 35 basis points for the 10-year 2-year spread, starts to invert further due to growth concerns, that's a harder sell for tech. We are seeing weakness in LII and open interest, which are rate sensitive. If rates stay higher for longer, the discount rate hits their valuations harder than the headline rate cut narrative.
So we have a technical breakdown in QQQ, institutional flows favoring safety, and a volatility environment that is skewed toward downside protection. Let's dive deeper into the specific tickers. First up, let's talk about the leader of the pack, healthcare, the healthcare sector. It's up 2.4% today. Grid, CIPHER, Pulse, what's driving this?
The healthcare sector is the definition of a trend continuation. It closed at $167.26. We are making new highs for the month. The structure is clean, higher highs, higher lows. There is no resistance overhead in the immediate term. The price action is strong with volume confirming the breakout. This is a pure technical long setup. Unlike QQQ, which is struggling, the technology sector has no such clarity. The healthcare sector is moving away from the mean.
The fundamentals support this. We are seeing earnings growth in the healthcare sector that is more resilient than tech. Companies in the healthcare sector are benefiting from an aging demographic and defensive spending patterns. Unlike SOFI or LII, where growth is discretionary or cyclical, healthcare demand is inelastic. The institutional flows I mentioned earlier are pouring into these names because they offer yield and stability. The COT data shows that while commercials are bullish in commodities, in equities, they are rotating into sectors with predictable cash flows. The healthcare sector is that sector.
And sentimentally, it's the only game in town. When fear and greed is at 39, investors don't buy growth, they buy safety. The II survey shows speculators are bearish, and the retail put ratio is high. This money has to go somewhere, and it's going to the healthcare sector and consumer staples. It's a flight to quality. The mood is not risk-on, it's survival mode. That drives the premium on healthcare stocks. Strong consensus. Now let's look at the laggard. Technology, the technology sector. It's down nearly 2%. Grid, is this a breakdown or a correction?
This is a breakdown. The technology sector closed at $171.09. We broke below the 20-day moving average yesterday. The 10-day range for QQQ, which is heavily weighted to the technology sector, shows a decline from 724 down to 675. That is a 5% drop in 2 weeks. The structure is broken. We are seeing a head and shoulders pattern forming on the daily chart for the Nasdaq. The neckline is at 685. We are testing it now. If we lose 667, the next support is the June low around 650. There is no volume confirmation for a reversal yet. This looks like a trend change, not a bounce.
I agree with the technicals, but the fundamentals are the driver. The earnings season data shows that while NVDA and MSFT had strong quarters, the guidance for the next quarter is being scrutinized. The buy the rumor, sell the news dynamic is pervasive. We saw NVDA up 121% year over year, but the market is asking, what about the next 120%? When you have that much expectation baked in, any slight miss or cautious commentary triggers a sell-off. Amazon is beating, but the market is waiting for the next big catalyst. Without a new narrative, the valuation multiples are getting compressed. The revenue beats aren't enough to justify the premium anymore.
Here is the counterpoint. You are all focusing on the break below support, but look at the breadth. The advanced decline line is at 1,171 advances versus 850 declines. That is actually positive breadth. The Zweig breadth thrust was detected. Historically, a breadth thrust like this is bullish. It suggests that while the index is down, more stocks are rising than falling. This disconnect between the index QQQ and the breadth, a /D ratio, is a classic divergence. It often precedes a rally. The VIX is at 18, which is not panic. If the Fed holds rates steady and signals no hikes, this oversold condition in tech could reverse quickly. The risk is not that tech keeps falling. The risk is that you short the wrong side of a breadth-driven bounce.
I disagree with SPECTER on the breadth signal. Yes, the A/D ratio is positive, but look at the sector breadth. The technology sector is down, QQQ is down. The breadth is driven by the defensive sectors we talked about. This isn't broad-based participation, it's a rotation. The thrust is happening in healthcare and staples, not in growth. That's a negative signal for the overall market leadership. The crowd is still fearful. The put/call ratio at 8.76 for SPY tells you that despite the breadth, the big players are hedging. They are not buying the dip in tech, they are buying insurance.
So we have a battle between grid technical breakdown and SPECTER breadth divergence. Let's look at a specific stock case study. SOFI, it's down 6% pre-market. CIPHER, why is this happening?
It's a classic guidance miss relative to expectations. The CEO raised guidance, but the market had priced in a much more aggressive expansion. When you look at the revenue growth, it's slowing. The cost of funds is rising. The earnings per share growth is decelerating. The institutional flow data shows that hedge funds are reducing their positions in fintech names. They are rotating out of high-beta financials into the defensive sectors we discussed. SOFI is just the poster child for this. It's not just SOFI, it's the entire fintech sector. The valuation multiple is under pressure because the growth story is no longer hyper-growth.
Technically, SOFI is a disaster. It's down 6% on high volume. That's a breakout to the downside. The stock is trading at $1.30 after a gap. The next support is the lows from last week. There is no support above here. The volume is elevated, which means there are sellers in control. This is a momentum breakdown. If it doesn't reclaim $1.50 by tomorrow, it's going lower.
And here is the risk. When a stock gaps down 6% on good news, it's a sign of extreme weakness. But look at the options market. SOFI implied volatility rank is at 98. Options are expensive. This suggests that the market expects further downside, but also that there is a high probability of a squeeze if the selling dries up. Short sellers are crowded here. If the broader market stabilizes, SOFI could see a violent short covering rally. It's a high-risk, high-reward setup, but the trend is firmly down.
Finally, let's look at OI Glass, open interest. It's crashing nearly 15%. CIPHER, what's the fundamental issue?
It's an earnings miss. The company reported earnings per share that missed estimates. More importantly, the guidance for the next quarter was weak. The glass industry is cyclical, and this miss suggests that demand is softening in the packaging and industrial sectors. The revenue beat was insufficient to offset the earnings per share miss and the negative guidance. This is a fundamental deterioration. Institutional investors are exiting these names. The flow data shows outflows from industrial and materials ETFs. Open interest is a victim of the broader rotation out of cyclical industrials.
On the chart, open interest is a gap down. It's at $7.71. This is a breakdown of the entire trend. The stock was in a downtrend for weeks and this earnings miss accelerated it. There is no technical support here. The next level is the psychological $1 mark. If it breaks $1, it could go much lower. This is a trend-following short setup.
Sentiment on open interest is negative. The news sentiment score is bearish. The crowd is piling on. When you have a 15% drop on an earnings miss, the fear is real. Investors are worried about the broader industrial sector. This reinforces the shift away from the industrial sector and the materials sector. The mood is stay away from industrials.
Let's bring it all together. Apex, we have a defensive rotation, a technical breakdown in tech, and earnings skepticism.
what is the equity outlook?
Okay, let's synthesize. Pulse identified the extreme fear and the flight to safety. Grid confirmed that QQQ and the technology sector are breaking key technical supports, with QQQ testing the low of the last 2 weeks. CIPHER showed that the fundamentals are shifting, earnings beats are being punished if guidance isn't perfect, and institutional flows are moving from tech to healthcare. SPECTER warned about the volatility skew and the potential for a breadth-driven bounce, but Pulse countered that this breadth is defensive, not broad-based.
So the takeaways are clear. First, the market is rotating. Money is flowing out of tech and into healthcare and staples. Second, the technicals on QQQ are weak, testing support at $667. Third, earnings are being met with skepticism, as seen in SOFI and open interest. And fourth, the Fed decision on July 29th is the wild card. If they signal dovishness, we could see a bounce. If they stay hawkish, the defensive trade continues. Let's review the weekly calls. It is Wednesday, July 29th. The Fear and Greed Index is at 39, and the put/call ratio is high. The defensive rotation is accelerating. I do not see the S&P 500 gaining traction. Reaffirm, SPY neutral, still targeting $73.5 by Friday.
The technical structure of the S&P 500 is holding, but the Nasdaq is breaking down. The S&P is trading at $740. The support at $735 is critical. If it holds, we stay neutral. If it breaks, we are bearish. But for now, the index is range-bound. Reaffirm, SPY neutral, still targeting $73.8 by Friday.
The synthesis of the data points to a choppy close. The defensive rotation is strong, but the Fed decision may provide a catalyst. However, without a clear dovish signal, the upside is limited. Reaffirm, SPY neutral, still targeting $74.0 by Friday.
So all three voices are reaffirming a neutral stance on the S&P 500, targeting the $73.5 to $74.0 range by Friday. The market is waiting for the Fed. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.